Okay, so today we're going to work on Chapter 18. There are two parts to Chapter 18 that are pretty distinct. Chapter 18 is a PDF file, so you don't have it in your book. You need to go to Canvas and download it. The two parts of Chapter 18 are lease valuation and firm valuation, and there are two completely distinct things. That we use some of the same tools, our usual present value kind of stuff, but they are two distinct topics. So today I'm going to talk leasing. Hopefully, wrap that up by Wednesday, and move on to firm valuation. And you'll need firm valuation for capstone. All right, so switch my camera. Okay, so we're going to talk, like I said, leasing, right? So some of you lease apartments, maybe your parents lease a car. I assume you don't lease cars, at least at this point in your lives. But we're going to, but firms, especially healthcare entities, regularly lease equipment, buildings, and a whole variety of things. And so the question is, do you care if you own an asset or if you just have access to the asset, right? So think about that. Like I have a friend who lives down in, he's got a place on Plum Island, and he used to own a boat, and he kept it at this marina down at Plum Island, and he would have to pay, maintenance on the boat. He had to, obviously had to buy the boat, insurance, fuel, all that kind of stuff, right? But he really just didn't necessarily want to own the boat for any particular reason. Really what he wanted was to be able to go on a boat with his family periodically. And so he found a deal at the marina where he'd been working where he could pay a flat fee to the marina, and he would have access within certain parameters to different boats pretty much anytime he wanted it. So all he had to do was sign up for a boat. He would go sign up for a boat on a Saturday morning, take his family out for 4 hours. He would show up, the boat would be waiting for him. It would be full of fuel. The family would get on the boat. They'd go out for a few hours, come back at noon, turn the boat in and leave. And they didn't have to worry about, maintenance of the boat. When it came to be wintertime, he didn't have to have the boat pulled out of the water and stored over the winter and all that kind of stuff. Owning a boat is actually pretty expensive. And so he figured out, kind of between the, all the various costs of owning the boat and then just basically all the hassle of owning the boat, that it was just better for him to pay that fee so that he would have access to the boat. I mean, it's not really a lease, but the point I'm trying to make is you don't have to own your equipment to be effective at running an organization, right? You just want to have access to that equipment. And so you can own or you can lease equipment. So you could, if you are an imaging center, for example, you could buy an MRI, right? Or you could lease the MRI. If you own it or you lease it, you have access to it. But there's some, there's some good reasons to own, and there's some good reasons to buy. To buy and to lease. We're going to look at the financial aspects of it. When we get to the end of the leasing section, we'll talk about some of the kind of justifications for why owning versus leasing, other than pure cost, are good reasons for whether you want to own or buy. Okay, so some terminology. A lessor is the owner of the property being leased, right? So if you are renting an apartment right now, your landlord would be your lessor, right? If you are the person who is paying to use the property, right? then you are the lessee. So probably on your lease, there's these phrases are used, the lessor and the lessee, right? So if you are renting an apartment, you are a lessee, right? And if your landlord is the lessor. So you want to kind of have those terms in your head. They're kind of obvious, but just keep in mind. Okay. So we are going to focus in this chapter on what are called operating leases. There is another kind of lease called a capital lease, right? Which I will talk about briefly, but we are going to be really just focused on operating leases. I do not plan to ask you any questions on the exam about capital leases. Okay, the level of complexity is just a little bit higher than an operating lease, but I want you to know you do need to know the difference. Okay, so let's talk a little bit about operating leases. Operating leases uh, uh, can be two different kinds. Um, a conventional lease is a series of fixed payments on a fixed schedule, right? So rent is a good example, right? So you guys rent your apartment. Your landlord says you're going to pay me, $1,000 a month on the first of each month. Right? That's a conventional lease. It's a fixed set of payments, right? $1,000 on a fixed schedule, first of the month. This is different from a per procedure lease. Procedure. All right, I can spell. Hang on. Per procedure lease, right? In which case you pay a fee, right, for each use. So you pay a fee for each use of the asset. So this is not, you would typically not see this in a like an apartment kind of lease, but it would be common for, say, certain lab machines, right? This is actually where I first learned about this, and I think I've talked about this in the past. My dad was a pathologist for a long, long time, ran the laboratory, and so he was presented, you got this fancy machine. It's going to cost you $300,000. You can buy it, you can lease it, and pay us a monthly fee, right? So you could buy it for $300. You could lease it from us and pay a monthly fee of say $5,000 per month, right? Or you could pay, right? So you could buy. I'm just making up numbers here. 300,000, right? You could lease conventional for say 5,000 per month, right? Or you could do a per procedure where you pay us say $25 per use, right? And so we come back and we count at the end, the end of each month. The machine now of course the machine would probably just automatically email the company and say, hey, the lab used the machine 47,000 times, so times, or I don't know, 450 times 25. That's how much they owe us this month. So there's a kind of three different ways that you could get access to the asset. You could buy the asset outright. You could lease the asset with a conventional lease where you're paying, say, some fixed amount of money per month. Or you could lease using a per procedure lease if that would be appropriate for the kind. And this, it's got to be appropriate for the property that you are looking to finance. So things like laboratory equipment where there's a clear measure of the number of uses, that's a per procedure lease would be an option. And then you can imagine a hybrid where you pay some fee per month, a flat fee, fixed fee, and then a per procedure amount on top of it. Okay, so a operating lease. A couple of things about so these are both two examples of operating leases, right? A conventional lease or a per procedure lease can both be operating leases. A operating lease the period of lease is less than 75% of the useful life, right? So, example, um, uh, uh, machine with 10-year life. If you had a lease for 5 years, right, that would be 5 over 10 would be 50% of the useful life. So that would be that would qualify as an operating lease. If your lease was 8 years, then that would be 8 over 10 or 80%, 80%, which is greater than 75%. So this would not qualify as an operating lease, right? It would become a capital lease. The other piece that's key, so that's one, right? One factor for a operating lease is the period of the lease or the life of the lease has to be less than 75% of the useful life of the thing being leased. So if the thing has a 10-year life, 75% of 10 years would be 7.5 years. So as long as the lease was less than 7.5 years, it could qualify as an operating lease. The other key thing to be an operating lease is the present value of the payments, of the lease payments, has to be less than 90% of the fair market value of the asset. So what does that mean? Well, if we leased a thing for, a 10-year right, so this is my timeline, right? And I'm going to pay some lease on this thing, and it's going to be $50,000 a year. And I've got a discount rate of, say, 10%, right? What's the present value of $50,000 discounted back at 10% for 10 years? So I just grab my calculator, right? And I say, okay, 10 years, 10%, $50,000 payment. What's my present value? 307,228, right? So if if that's the present value of the lease payments, then make that positive, then the purchase price can't be if the purchase price is less than 341,000 in this case, 5, then I would be exceeding the 90%, right? So the present value, so let's say the purchase price of, well, this is a good example. Let's say this is the example I just used a second ago where I was talking about to buy the machine is 300,000, or you could lease it for $50,000 per year, right? If the purchase price is 300,000 and the present value of the lease payments is 307,228, right? That's bigger than 90% of 300,000. So in this case, because the present value of the lease payments, should have said instead of cash flow, I should say lease payments, is greater than the purchase price, then this would not qualify as an operating lease, right? If the purchase price was $300,000, then the present value of the lease payments would have to be less than $270,000. Okay, does that make sense? So what we're doing is we're testing. Give me a thumbs up of some sort if that doesn't make sense, or a question mark if it doesn't make sense. So I'll just repeat a little bit, right? So what we're doing is we're testing. We say, okay, say the purchase price is $300,000. When I calculate the lease payments, they can't. When I calculate the present value of the lease payments, they have to add up to less than 300,000. Less than 90% of 300,000. So they'd have to be 270,000. I'm not seeing any response. Got it? We good? Thank you. All right. So those are the two key tests to see whether you have a operating lease. Test number one was period of the lease is less than 75% of the useful life of the asset, right? So if it's a 12-year, an asset that's going to last 12 years, 3/4 of 12 years is 9 years. So as long as the lease was less than 9 years, you'd be good to go. With a 10-year lease, as long as the lease is less than 7.5 years, you're good to go. Second test is the present value. Is the present value of the lease payments less than or equal to 90% of the market value, right? The price that you would have to pay to buy it. Then as long as the present value is less than 90% of the purchase price, then you're good to go. All right, Jisoo, question. $341, so that would be 307 divided by 0.9 to get what would 307 be 90% of? So I kind of did it backwards. I said, all right, if the present value is 50,000 per year, what would 307 be 90% of? So I divided by 0.9, and that got me 341. I was just trying to come up with a number that would work with if we had a present value, if we had $50,000 payments and a 10% discount rate. I was kind of we figured out that would be worth $307,000. So then I was trying to figure out, all right, if the present value of those lease payments is $307,000, what would that be 90% of? So what would the purchase price have to be in order for this to be okay to be a operating lease? So if in this case, this was true, that these were the lease payments and the discount rate was 10%, then the present value of those lease payments would be 307 and some change, right? What purchase price, right? What market value would the asset that we're leasing have to be at least? And in this case, it would have to be at least 341,000. So if this was true, right, that they had $50,000 lease payments, 10% discount rate, if the purchase price of the asset was, say, 350,000, then that would be fine. That's 90%. So you're saying for 307 to be an op lease? Yes, that's what I'm saying. Okay. So another example, right? So let's say the equipment is selling for 100,000. 90% of 100,000 would be 90,000, right? So and let's say this is 0, 1, 2, 3, 4 4-year a 4-year lease. So we could buy it on the market. Market price is 100, or we can lease it for, say, 20,000 per month, right? And let's say we have a discount rate of 7%. The present value of the lease in this case would be payments of 20, 4 years, discount rate of 7, present value would be 67. So PV would be 67,000, which is less than 90% of the $100,000 purchase. Okay. So in this case, that'd be thumbs up. That'd be good to go from that perspective. Right? So it's the lease payments would represent less than 90% of the market price of the asset. Maybe that's a little clearer. I'm just making stuff up on the fly, and that can get a little messy. Okay. So operating lease, right? As opposed to a capital lease. Well, a capital lease, obviously, the facts that we just said apply, right? So a capital lease is very almost like owning. So, for example, you might, if you were building a new factory, you might lease the factory, work with a builder to build the factory, and then you would lease the factory for, say, 30 years, right? Lease 30 years. And the expected life of the factory is 30 years, right? So the lease and the life of the asset are the same. So that violates the operating lease assumption. And the present value, let's say it's going to cost $1 million to build, or and the present value, typically the present value of the lease payments will equal 1 million, right? And so this is called a capital lease. And one of the key differences is that when you get a capital lease, it shows up on your balance sheet. Okay. So with a operating lease, there are no entries on the balance sheet. There is an entry on the income statement, right? So remember, income statement. You would have a lease expense, right, of however much your monthly payments are, right? So let's say that's $10,000 per month. Again, just making numbers up. So that would show up. If this was an operating lease, that's all you would see. There would be, and if it was an operating lease, right, you have your assets and your liabilities and owner's equity, right? There would be no entry down here for the asset if it's an operating lease. But in this case, if it is a capital lease, then what shows up on the asset side is leased asset for 1 million. Sorry, I'm running out of space. And then lease liability of 1 million on the liabilities and owner's equity side, right? Under liabilities. Let me get a better sheet of paper to show that. So if we have a $1 million, the value of the asset is 1 million, and the present value of the lease payments is equal to 1 million, then, and this would be a capital lease because the present value of the lease payments is equal to the market value of the asset, not less than 90%, right? And then the life of our lease that we were just saying is equal to the expected life of the asset. So we have on the asset side, we would have a thing called leased asset, and it would be 1 million, right? And then on our liabilities and owner's equity side, under liabilities, we would have lease liability of 1 million, right? And so, you know, if you, and then that would be added on to whatever else they already had. But, you know, balance sheet, right? It's got to be the same on both sides. Remember that from way back in chapter 4. Okay. Now, what happens over time is as you pay down the lease, right? As you pay the lease liability progressively gets smaller. You get it gets amortized, just like when we did a mortgage example. I forget what chapter it was, but we did a mortgage example, right? It would get amortized down. On this side, the leased asset would get depreciated, and the two don't necessarily match up after the initial leasing, right? And then this would play in. This becomes a liability just like a loan, right? Because it is essentially a loan. If you get with a property owner and you might see this when you drive down the highway, you might see a sign saying something like build to suit or something like that. It'll be a sign, you know, for lease, build to suit, right? And that might be just an empty lot of land. And so what they're really offering is a long-term capital lease where the owner of the property will retain ownership of the property, but build you a building that you will use, you know, for 20 or 30 years. And so it's essentially a long-term loan from the builder to you, right? So the lessor is the builder, you become the lessee, okay? Now, this is not true for an operating lease, right? For an operating lease, there are no entries on the balance sheet. It's as if it, you know, strictly from the balance sheet perspective, as if it's not happening. So how does this affect, how does this affect our balance sheets? Well, let me use another example. Just gotta grab some more paper. Okay. So let's imagine we've got a firm that starts with a balance sheet of current assets of 50, PPE of 50, right? For total assets of 100. And then on the, this is the asset side, liabilities and owner's equity. They've got, say, liabilities of 50, and they've got equity of 50 for liabilities and owner's equity of 100. Okay, so we're balanced. Now they want to acquire a new piece of equipment. Let's say this is, we'll split this into two different firms. We have firm B who buys, right? So they're going to buy the asset, asset market value is 100. Okay. So firm B buys the asset. So what happens? Well, they got no effect on their current assets, right? PPE increases from 50. They buy $100,000 asset. So their PPE goes up to 150. So now their total assets is 50 plus 150 is 200. Their liabilities and owner's equity for firm B, you've got, uh, and in order to buy the asset, they take out a $100,000 loan. So now liabilities go from 50 to 150. Equity stays at 50. And so you have liabilities and owner's equity of 200. Right? So they took out a $100,000 loan to buy the $150,000, $100,000 asset. So PPE goes up by 100, liabilities go up by 100, right? And then we're balanced. 50 plus 150, 150 plus 50, 200. So that's firm B. Firm L instead decides to get an operating lease. And so with an operating lease, nothing happens, right? With an operating lease, there are no balance sheet entries. So they get the $100,000 asset and nothing happens. Okay, so that's an operating lease. If it was a, and so it looks, so if you lease operating lease, no effect. Current assets 50, PPE 50, total assets 100, liabilities and owner's equity, liabilities 50, equity 50, liabilities and owner's equity 100. Okay. The difference here, though, is, or the point that needs to be made is, both of these firms now have a $100,000 asset, right? An additional $100,000 asset. So if we go, and start to calculate these firms' respective ratios, for B, for firm B, firm B's debt ratio, right, which is liabilities divided by total assets, is 150 divided by 200, or 0.75. Firm L, right, firm L's liability debt ratio is 50 divided by 100 initially, and it stays that way. So firm L's debt ratio is lower, even though both of the firms have access to the same resources, right? To the same assets. And then if we looked at the ROA, let's assume that they both make net income of 10, right? So firm A and firm B both make net income of 10. So for firm B, right, the ROA is going to be 10. Right? ROA is return on assets. So total assets 200, 10 over 200, right, which is 1/20th or 5%. ROA for the lease firm is 10 over total assets of 100, right? And you wind up with 10% ROA. So even though technically they both had access to the same assets, right, from a, if you're strictly looking at their financials and you're not aware that firm L has a lease, it would look like firm B, so firm A, firm B is less profitable than firm L. So typically some, and we talked about this a long time ago, when we do financial statements, right? So when we create an income statement and a balance sheet and cash flows and statement of changes in owner's equity, right? When they put all that together in the real world, so like if I showed you, I think I may have shown it to you or given you a copy of it, like Exeter Hospital's um, financial statements. So they're audited financial statements, or we've got a few online. I can send it to you. The balance sheet takes like a page. The income statement takes a page. Statement of changes in owner's equity takes a page. The cash flows takes a page. So that's like 4 pages for all the statements. And then there's 40 more pages of notes that support those 4 pages. So the actual uh, uh, financial statements are 44 pages long, 4 pages of actual, statements that we've talked about, and then 36 pages or 40 pages or whatever I said of notes that clarify things like, oh yeah, and by the way, it doesn't show up in the balance sheet, but we have this enormous operating lease that we have to pay. So those are things that, as you become more sophisticated in your analysis, you will start to pay attention to, and so just looking at the financial statements, those basic statements that we have spent a lot of time looking at, you're not going to see kind of everything that's going on in the firm unless you actually read the notes to the financial statements. Okay, let's see. We're doing pretty good time. Okay. So one of the things that we've talked about in the past is, let me make a point here, is debt capacity, which is really a question of how much debt can a firm take on. And your debt ratio kind of gives you an idea of, well, it tells you where the firm is actually at, right, in terms of debt. And then you'll have some target financial structure where we want to be at 50% or 60% or 40%, or whatever the standard is. So if the industry average is 60% and you're at 40%, then you can afford to take on more debt. If the industry average is 50% and you're at 60%, then you have kind of exceeded your debt capacity. There's a little more nuance to that. But leases can wind up using up your debt capacity. And depending on whether they're an operating lease or a capital lease, how it looks from a financial statement perspective can vary. Okay. But in reality, even though it's not showing up on the financial statement, the debt capacity might have been used up, because just like with, if it were a loan, right? So we were comparing loan versus leasing, right? If you've got a lease, the lessor expects you to pay that lease, just like the bank expects you to pay your mortgage, right? And if you don't pay it, they can declare you are in default and can take your asset away from you, right? So and one of the advantages of being a lessor as a and leasing people resources as opposed to being a lender and lending money is the lessor still owns the property, right? And so there's not really any question. So if you go bankrupt, the lessor just comes and takes their property away from you because it's their property, as opposed to a bank would, you have to have a fight about who's got the, who owns the asset and who's got the rights to the asset. Okay. So let's see. That capacity. All right. So now we're going to talk And the other thing, the other thing to keep in mind is when we shift my camera back. Remember we talked about if you had some EBIT, right, some earning before interest and taxes, and this is kind of like your operating income, right? And so let's say you have 100 in EBIT. If you have a lease, right, that's going to reduce your available EBIT, right? So let's say you have a lease payment of 20,000, right? Your EBT, right, would be 80, right? As opposed to if you didn't have a lease payment, it would be 100. And so we did some examples in chapter, was it 14, 13, right? Where maybe 12, I can't remember now, where we said, okay, so we've got we've got a 50% chance of getting an EBIT of 100, but we've got say a 25% chance of getting an EBIT of 50 and a 25% chance of getting an EBIT of 150, right? If we had 20, right, then we wind up with 30 or 130. Do you remember, as opposed to if we didn't have these payments, right, you would have 150 and 150. What this creates, what leases create, is additional financial risk, just like if this was an interest payment, which is what we work with in the past. And why is that? Because regardless of the economic conditions that your firm is operating under, the lessor expects to be paid his or her lease payment, just like a bank would expect to be paid their interest payments. Okay, so it increases financial risk by having a lease. All right, so let's work an example now. This is where there's a few things that you've got to keep in mind when you're estimating a lease versus buy arrangement. Okay, so we're going to set ourselves up, and what we're going to assume is we're a radiology group, and this is out of the book. Okay, so if you don't get it just right, go ahead and read the chapter. So, radiology group going to buy a $100,000 X-ray machine. They've made, so here's a key point. They have done their analysis like we did in chapter 15, their capital budgeting, and they said, we want to go ahead and buy or get access to a X-ray machine. The market value of the X-ray machine is $100,000. We can either buy it or lease it, okay? And if we buy it, we will have a 10% interest rate, right? So we're going to pay 10% on our interest. We're going to take out, if we buy it, we're going to take out a loan at 10%. If we lease it, it will cost $55,000 per year. Okay. So let's start our analysis. All right. So we're going to buy the equipment at time 0, right? And we buy the equipment, that's a minus $100,000 cash flow, right? But then we get the loan to buy the equipment, and so that is a positive 100. Excuse me. That is a positive $100,000 cash flow. If we assume simple interest payment, or simple interest, meaning we're going to pay 10% per year. We're not going to do a mortgage. We're just going to pay 10% on the loan, and then at the end of the loan, we'll pay the principal back. We're going to make some sort of interest payment. So it'll be interest expense, right? And that'll start in year 1. And 10% of 100,000 is going to be a outflow of 10. And then in year 2, we're going to also have a outflow of 10, right? Now, we're not making a decision about whether or not we should get this piece of equipment. We're trying to figure out which is cheaper, to lease the equipment or to purchase the equipment. So if what's relevant here is the outlay to purchase the equipment, the loan cash flow into purchase the equipment, the interest expense. But if I have interest expense, think through what happens on my income statement. Excuse me, hang on one second. Sorry, need to blow my nose and you didn't need to hear it. Okay, so if I have interest expense, right, on my income statement, so let's say I have EBIT of 100 and I have interest expense of 10 as opposed to EBIT of 100 and no interest expense, then I have EBT, earnings before taxes, of 90 versus 100. If I pay 40% taxes, then if my tax rate is 40%, then I'm going to pay 0.4 times 90, 36,000 in taxes as opposed to 40,000 in taxes. So then my net income is going to be 90 minus 36, 54, as opposed to 60, right? I have a tax savings, right? If I pay interest expense, I wind up paying 4,000 less than if I don't have interest expense, right? So I actually have a $4,000 tax savings, right? Based on the fact that I paid interest. So to figure out the tax savings, I'm going to take the interest expense times my tax rate, right? So in this case, that's going to be 10 times 0.4 is going to give me tax savings from my interest of 4. So if I assume in this case that I have a 40% tax rate, which I'll write over here, tax rate 40%, then my tax savings is going to be 4. And I'm going to put it in as positive, right? So any cash flow that's going out is going to be negative. Any savings or cash inflows are going to be positive. So my net interest expense is really 6, right? It's 10 minus 4. So if you push the tax savings and couple it with the interest expense, then you get the true interest expense, which is really 6, not 10, right? Because with a 40% tax rate, it reduces my the actual or effective interest. Okay, so then I have to, at the end of year 2, I have to pay back my principal, and that's going to be $100,000, right? And then tax savings on depreciation. Okay. So how does, so if we assume, if we assume simple depreciation, right? So if we have an EBIT, let's say of 100, well, this would be an EBITDA, I guess. I don't want EBIT. I want revenues of say 100, non-depreciation, non-D expenses of 20 and depreciation of 20, right? My my taxable, and I'll ignore interest right now. My taxable income becomes 100 minus 20 is 60, right? And then I pay taxes at 40%, right? 0.4 times 60 is 24, right? And so 60 minus 24 is 36. So my net income is 36. If I had no depreciation, I'd have 100 minus 20 minus 0 would be 80. 0.4 times 80 is 32, right? Minus 80 is 48. What's the difference in tax burden? Right, I get a $8,000 tax shield. Remember that? Tax shield from my $20,000 depreciation, right? Because I take my depreciation times 1 minus the tax rate. Depreciation times the tax rate. So that would be the tax shield. So in this case, that would be 20,000 times 0.4, right, is 8. Okay. So in this case, if I assume that I'm going to depreciate the asset over 2 years and I'm going to use straight line depreciation, if my equipment costs 100,000, then depreciation is going to equal 100 divided by 2. So my depreciation expense, right, is 50. What is my tax savings going to be? Well, what's my depreciation shield? Really, that's what I'm asking here. What's my depreciation shield? Where if my depreciation expense is 50 and my interest tax rate is 40, then I take 0.4 times 50 and I get 20. So I have a tax savings resulting from depreciation of 20 each year. And then finally, oh yeah, we got that. Okay, this is a little out of order. I probably should have done the depreciation before the principal payment. Doesn't matter. It's all gonna, it all goes to the same place. So my net cash flow is going to be minus 100 plus 100. For year 0 is 0. Minus 10 plus 4 is 6. Plus 20. What am I doing? Sorry, hang on 1 second. Sorry, a little bit of brain lock there. So I've got minus 10 plus 4 is minus 6. So minus 6 plus 20. is 14. I was doing 10 plus 4 is 14 plus 20. I couldn't, it just, sometimes your head just does the wrong stuff. Okay, so minus 10 plus 4 is minus 6. Plus 20 is 14. Minus 10 plus 4 is minus 6. Minus 100, so that's minus 106. Plus 20, so minus 106 plus 20 is 86. So our cash flows from purchasing are going to be in year 0, 0, in year 1, plus 14, and there you go again. And then in year 2, minus 86, because you have minus 10, plus 4 is minus 6, minus 100 is minus 106, plus 20 is minus 86. All right. Good. And so, so that's our cash flows for purchasing. Now, what about if we lease? Okay, so we said that instead of buying, you could lease. And in the book, the way they've got it set up is you're going to pay your lease at the end of each year. So I'm going to go with the book example, then I'll show you. I'm not sure why the book did it that way, because typically you pay leases at the beginning of a period, as you're probably familiar with. So the leasing cash flow is going to be um, uh, uh, lease payment. And we're going to assume we pay at the end of the year. So we said that the lease payments were going to be 55 and 55, and those are negative because they are cash outflows. So nothing at time 0. Lease payment at the end of year 1, lease payment at the end of year 2. Okay, so that is an expense, right? So any expense that you have is going to reduce your taxable income. And so there is a tax savings from lease that is going to be equal to, just like with our depreciation shield, we're going to take the expense, which is 55, and multiply it by 40%, because that's how much our taxes will be reduced by. So 40% of 55 is 22. And that's a savings, so that's a positive number. And that's it. Pretty straightforward. So the net cash flow is going to be 0. Negative 55 plus 22 is negative 33. Twice. Okay. So we have 2 cash flows to compare. Let me see if I can do this. All right. We've got the cash flow from purchasing, which is going to be 0, 14, and minus 86. The cash flow from leasing is going to be 0, 33, 33. So we want to compare our 2 purchasing options, or our 2 options, purchasing versus leasing. So the question is, and the way we're going to do that, of course, is because those cash flows are happening in the future, we need to calculate present value. So if we need present value, we need a discount rate. So what is the appropriate discount rate? Well, you could say, well, what could be the corporate cost of capital? That would be an appropriate thought if we were trying to decide not on purchase versus lease, right? But whether we should do the project or not at all. But since we've already made the decision to do the project, what we want to use is the appropriate discount rate based on the cost of purchasing. So in this case, what we said was we're going to take out a loan to purchase the equipment. So we will use the purchasing discount rate, or the discount rate that arises from our interest rate on our loan. But what is the true interest rate? Is it really 10%? And the answer, because I've got short, I want to wrap this example up before we stop, is you got to go back here. At 10%, yes, indeed, we are in fact going to pay the bank 10%, right, interest on our loan. So we're going to pay the bank $10,000 each year. But remember the tax savings from paying interest. We're going to pay $4,000 less in interest. So the actual interest rate is 10 minus 4 over 100, right? Or 6 over 100, which is 6%, not 10%. So the appropriate discount rate is to use in this case is the after tax cost of debt, right? Which is going to be, remember our formula, AT equals BT times 1 minus T, right? So that's going to be 10 times 1 minus 0.4, which is going to give us 6% in this case, right? In this case, right? So our before tax interest rate is the 10%. Our tax rate is the 40%, right? So our after tax effective cost of debt is actually 6%. So we're going to use 6% to discount each of the cash flows. So we've got a cash flow here of 14 and 86. If I was doing this in Excel, it'd be faster. The easiest thing to do here is to say, okay, the present value of 14 is just 14 divided by 1.06, 13.2. The present value of negative 86 is 1.06 squared inverted times negative 86 is 76.5 roughly negative, right? So the present value of the cash flows is 13.2, 63.34. Okay, negative, right? So it's a negative. So it's going to cost us $63,034 to buy it. And I'll stop on this. So then we have what is the present value of two negative 33 payments. So if I've got 33, I could do payment. 2 is my N. 6 is my interest per year. Compute PV 60.5. Right. Negative. Right. So it's going to cost me 60.5 to lease the asset for 2 years, or it's going to cost me 63.34 to purchase the asset. So the cheaper option, right, is to lease the asset. The last idea here, and I'll stop, is called the now, or the net advantage to leasing. And that is simply to take the present value of the lease minus the present value of purchasing. So that would be 60.5 minus minus 63.34, right, gives us a positive 2 point. I know my calculator is negative, but I didn't put the negative in. Right, so it's negative 60.5 minus 63.34 gives us a positive 2.8. So that shows us that we have a net advantage of leasing because the present value of the lease payments is less than the present value of the purchases. 1 minute over. So we'll pick up with this next time, do a slightly more complicated calculation, and then and wrap up leasing, and then move on to firm valuation. All right, I'm going to stop there. Stop my recording.